Hey IPO investors, welcome to today's explainer. Okay, let's just dive right into this. If you've been tracking the markets lately, you already know the SME IPO space, that's small and medium enterprises, has been absolutely on fire. Today, we're going to break down the mechanics, timelines, and the raw financial data of two massive upcoming SME IPOs hitting the market. We're looking way beyond just the hype to understand the actual numbers driving these valuations.
Here's a quick look at our roadmap. We'll start with the current SME IPO market, then spotlight Q-Line Biotech and break down its financials. After that, we'll pivot to Credent Connect N Care, run through their IPO timelines, and finish up with the investor quotas and requirements.
Section 1. Current SME IPO market and gray market action.
So the sheer heat in the unofficial market right now is just fascinating. Looking at the latest GMP tracker, there is massive volume and exceptionally high premiums across the board. I mean, companies like Dute Transmission are commanding a staggering unofficial premium of plus 276 rupees per share. And Molbio Diagnostics, they're sitting at plus 154 rupees. Even one of our case studies for today, Credent Connect N Care, is already showing a GMP of plus 50 rupees. This really shows an immense appetite from investors who are willing to pay a hefty premium before these shares even officially list on the exchange. But remember, GMP is entirely unofficial and it can change rapidly based on broader market volatility. Still, it's a super powerful real-time indicator of retail and institutional sentiment right now.
Section 2. Spotlight on Q-Line Biotech. So who exactly is Q-Line Biotech? Well, they operate in the highly specialized in vitro diagnostics sector. They develop and manufacture essential medical supplies like reagents and point-of-care devices. And notably, they really stepped up during the pandemic to produce critical COVID-19 testing kits, including RT-PCR and RNA extraction kits. Plus, they aren't some new, untested player just jumping on the IPO bandwagon. Q-Line has built its brand over 12 solid years. In that time, they've established a robust, direct supply chain to diagnostic service providers, major hospitals, and medical colleges. Honestly, that longevity is a key factor we look for when assessing the stability of an SME.
Section 3. The Q-Line Financial Breakdown. Taking a look at their top-line trajectory, it shows clear, consistent, and frankly, really impressive growth. We're looking at a jump from roughly 185 crores in FY23, stepping up to 206 crores in FY24, and then boom, taking a massive leap to over 322 crores in FY25. On the surface, this is exactly the kind of exponential growth curve you want to see in a pre-IPO company, right? It suggests they are scaling operations and expanding their market reach. When revenue jumps by over 100 crores in a single year, that indicates some serious momentum. But here's where it gets a little complicated. The bottom line tells a slightly different story. Check out the profit after tax, or PAT. Despite that massive revenue jump in FY25 to 322 crores, their actual profit dropped to 28.13 crores. According to the filings, this was due to some extraordinary accounting adjustments totaling nearly 17 crores. But then look at the most recent data. In just the first 9 months of FY26, they posted a bumper profit of 38.69 crores on 236 crores of revenue. This sudden, supercharged profit spike right on the eve of their IPO, yeah, that's definitely catching the eye of analysts. It raises some totally valid questions about long-term sustainability and whether those margins can actually be maintained once they're a publicly traded entity. Which brings us to a really crucial conversation about valuation. Because Q-Line has no direct listed peers in the current market for an apples-to-apples comparison, reviewers like Jagat Joshi over at IPO Watch note that the issue appears fully priced. They are commanding a price-to-earnings ratio of 28.44 based on those FY25 earnings. Basically, the absolute lack of listed competitors gives them a ton of pricing power right now. They get to dictate the narrative of their sector's value, and they seem to be utilizing that leverage fully to extract a premium valuation from incoming investors. Just to wrap up the Q-Line analysis, if you are a retail investor eyeing this opportunity, you really need to be aware of the scale and the capital required. This is a very large SME issue at 214.48 crore rupees. The price band is set between 326 and 343 rupees, but pay close attention to that minimum application, 800 shares. If you do the math at the upper price band, you're looking at a substantial upfront capital commitment of over 2.74 lakh rupees just to submit a single application during that super tight May 21st to May 25th window. That is a very high barrier to entry.
Section 4. Spotlight on Credent Connect N Care. Formerly known as Credent Cold Chain Logistics, this company is hitting the market to raise 93.90 crore rupees.
What really stands out structurally here is that this is strictly a fresh issue of shares. There is absolutely no offer for sale or OFS component where existing promoters are cashing out their personal stakes. This SME IPO is targeting a market cap boost entirely through new shares, which have a face value of 10 rupees each. Generally, this is seen as a very positive signal because it means the funds being raised are intended to flow directly into the company itself for things like working capital and operational expansion, rather than just into the founders' pockets.
Section 5. Credent IPO Timelines. If you're planning to act on this, the window is incredibly tight. The IPO opens on August 13th and closes just a few days later on August 17th. The basis of allotment is finalized the very next day on the 18th, and it hits the NSE SME board for listing by August 20th. This accelerated timeline means you do not have weeks to sit around and weigh your options. You need your capital ready and your strategy locked in well before the opening bell. 2,268,000 rupees. Let that number sink in for a second. This staggering figure is the absolute minimum investment required for a retail investor to participate in the Credent IPO. High minimums like this are a classic hallmark of the SME board. They're designed by regulators specifically to weed out casual speculation and ensure that only serious investors with higher risk capital play in these smaller, potentially much more volatile listings. So how exactly do we arrive at that massive entry barrier? It's just simple math driven by strict market rules. You take the upper end of the price band, which is 189 rupees per share, and multiply it by their mandatory minimum bid lot of 1,200 shares. This effectively prices out smaller retail participants who might normally just drop 15,000 rupees in a main board IPO. It requires high conviction from anyone deciding to tie up over 2 lakhs in a single application.
Section 6. Investor Quotas and Requirements.
Let's look at how this 93.90 crore pie is actually being divided up. Exactly half of the entire offering, 50%, is reserved exclusively for qualified institutional buyers, or QIBs. Securing a 50% QIB anchor is a really strong show of institutional confidence. That leaves 35% for the retail category and 15% for non-institutional investors, which we often refer to as high net worth individuals, or HNIs.
But, the rules get even more granular than that. As detailed in the official red herring prospectus, that 15% NII quota isn't just a free-for-all. It is further split based on specific application size thresholds. 1/3 of it is reserved for applicants bidding between 2 lots and up to 10 lakh rupees. The remaining 2/3 are strictly reserved for applicants bidding over 10 lakh rupees. It's a highly structured tier system designed to manage large allocations and prioritize the heavy hitters in the HNI space.
Similarly, if we look at that massive 50% QIB portion, the prospectus ensures that up to 5% of that net QIB portion is carved out and allocated proportionately to mutual funds first. If mutual funds don't subscribe fully, then that portion just falls back into the general QIB pool. This structural detail is super important. It highlights just how eager the issuers are to secure stable long-term institutional backing right out of the gate, which can really help stabilize the stock price post-listing.
So, with all this data untangled, from the bumper pre-IPO profits of Q-Line to the steep 2 lakh plus entry barrier of Credent and those aggressive premiums in the gray market, the final step is really up to you. How do these aggressive SME IPO valuations align with your own personal investment strategy and risk tolerance? Do the fundamentals actually justify the price? Or is the market just running a bit too hot right now? Take these numbers, compare them with your strategy, and always double-check the company financials before applying. For more deep dives like this, be sure to subscribe to Market